Okay, good morning, everyone, and thanks for joining us this morning. For those of you whom I haven't met, I'm Pete Little. I'm part of the investment team at Anchor here, and I focus on the global macroeconomic environment and asset allocation, and I'm going to get us kicked off today. So this webinar is the latest in our quarterly series of Where Will the Money Be Made? It relates to a document that we put out on a quarterly basis where our investment team takes a step back and looks at where we think the sort of most likely path is for the various asset classes over the course of the next 12 months. And so what you're seeing on the screen here is a summary of the conclusions that we came to. The conclusion that we came to was that we're fairly constructive, or most constructive, on equities, both domestically and globally over the course of the next 12 months. It's probably going to feel a little uncomfortable because that's certainly over the last at least 6 months, we see a lot of uncertainty. But looking underneath the surface, we see lots of opportunities there. For bonds, we're still pretty constructive. The yields, both globally and domestically, are at levels that we haven't seen for at least a decade or so. So those are looking pretty attractive there as well. So I'm going to kick us off by talking a little bit about the macroeconomic backdrop that we expect to persist over the course of the next 12 months. I'm going to hand over to Nolan, who's going to talk about the currency and fixed income markets and where we're finding opportunities in those to make money for investors. He's going to hand off to Pete Armitage, who will talk about the equity environment, again, both globally and domestically, and where we're seeing opportunities in those. Both of those guys are going to chat not only about the sort of broad experience that we expect investors to see in those asset classes, but also more specifically as fundamental investors, where we're finding individual opportunities under the surface to make money for investors. And along those lines, we're going to hand off last to James Bennett, who's going to talk specifically about the opportunities that we're seeing in the technology sector. During the course of our presentations, you're going to have the opportunity to ask questions via the chat function, which you should hopefully be able to locate somewhere in your screen. And we're going to try and get through all of the 4 presentations first, and then we'll address as many of those questions as we can at the end of the session. So please feel free to type those questions in as we go. So as I said, I'm going to start us off by talking about the macroeconomic backdrop that we expect, and the macro variable I think is most likely to have the biggest influence over the course of certainly the next 6 months, but probably at least the next 12, is going to be inflation. And if we think about inflation, most of us view it in a fairly negative context. I've got a quote here from an American baseball player from the 70s and 80s that said, inflation is when you pay $15 for a $10 haircut that you used to get for $5 when you had hair. And that sort of frames probably how most of us view inflation. We have the value of certain goods and services anchored around what we used to pay for them, and inflation takes the price of those things above that. And so we tend to feel like inflation makes us feel like we're overpaying for things relative to their value. But inflation is not always bad. Inflation is just bad when it's either too high or too low. So when inflation is running too hot, it tends to erode the value of our savings and our purchasing power. When it's too hot and it's volatile, it also makes it very difficult for us to do long-term forecasting. So what we tend to see is that it's difficult to make big capital spending decisions because you're not sure about the return that you're going to get on those. And so high inflation tends to delay capital spending decisions, which is obviously negative for economic growth. Conversely, if inflation is too cold or too low or even negative, that can also be bad in that it allows us to delay our economic activity. So you can delay spending decisions without consequence. If you wait to buy something, it'll probably be the same price or even cheaper down the line. And what that results in is delayed economic activity causes economic momentum to wane, and then you lose economic momentum. And much like economic activities like riding a bicycle. If you slow it down too much, it falls over. So you need it to keep going. And that's why there's typically an optimal level of inflation that economies need to run at to keep them keep the momentum going. In developed markets, that's typically around 2% per annum. In emerging markets like our own, that's usually slightly higher. I think we think 4.5 is probably the most efficient level for inflation for our economy currently. And if economies are running at that efficient level, it's just creating just enough of a carrot for us to not delay economic activity, and this builds economic momentum. So inflation by itself is not bad. It's just bad when it's too hot or too cold. And certainly in the current environment, inflation is too hot. And so inflation at its core is basically a mismatch between the supply and demand of various goods and services. If there's not enough demand, if there's not enough supply to meet demand, then prices tend to rise to a level where demand starts to get destroyed. And if we look at the current inflationary environment, particularly in developed markets, where we're seeing prices abnormally high, or inflation certainly running at suboptimal levels, well above the sort of 2% target range. Most of what's driving that is caused by the pandemic. So if we look on the right-hand side, the things creating this excess demand. During the pandemic, we had an environment where investors were unable to spend on a lot of services. And typically in developed market, investors or consumers spend about 2/3 of their disposable income on services. So when they were unable to spend on services, we started seeing some of that spending get redirected towards goods, which obviously increased the demand for goods. At the same time as that was happening, governments were worried about the impact of shutting down economic activity. And so they threw a lot of stimulus at the economy. And we saw even in the US, people were getting mailed checks from the government. You're seeing increased unemployment benefits. And so all of this additional money that was getting thrown at consumers was also helping to create this excess demand, which was all being directed at goods, or a lot of which was being directed at goods. Now, the last part, this fiscal stimulus, was mostly a developed market phenomena. We didn't really see that happening much in emerging markets like our own, which is why we're seeing inflation much more problematic in developed markets than we are in the emerging markets. And then on the flip side of that, on the supply side, obviously when we saw all of this excessive demand, it was also at the same time when the pandemic had resulted in factories and things being shut down, so we weren't able to produce the goods. The people who were moving those goods around were often at home, or in some cases sick, and so they weren't able to supply those goods. And when we did eventually start being allowed to move and manufacture again, what we found was that the infrastructure wasn't able to cope with it. So a lot of you will have seen pictures of these queues of ships, of hundreds of ships waiting outside ports to try and get in and offload some of the goods that were being demanded by these consumers who were now sort of focusing their spending on goods with all of this extra money. And so this created a lot of tension in the economy, and obviously prices rose as a result of that. And then, as if the pandemic didn't create enough of an issue, we then had earlier this year the war in Ukraine. And Russia, obviously big suppliers of food and energy to the global economy. And so that created another major supply constraint there. And the food and energy prices tend to be very front and center for us as in terms of inflationary impact. We tend to feel those most obviously, but most economies actually produce two levels of inflation, what they call headline inflation, which includes the inflationary impact of food and energy, and then core inflation, which excludes those components. And the reason they do that is because those components tend to be very seasonal, very impacted by weather or geopolitical events, and it tends to create a lot of noise, which ultimately nets themselves off. So if we focus on headline inflation first on this slide, I'm looking specifically at US inflation because it basically sets the tone for global monetary policy, and that sort of ripples out into the rest of the world. So what I've got on this chart here is a line that goes from the bottom left to the top right, the squiggly dark black line, which shows the trajectory of prices in the US at a headline level over the course of the last decade or so. And then to try and put that into context, I've created this nice straight dotted line, which is the trajectory that prices would have taken if they were running on this nice, neat 2% per annum optimal level over the course of the last decade. Then on the bars I've got at the bottom, I've taken the month-on-month change in prices and I've just annualized it, so multiplied it by 12 to sort of see what the run rate of pricing activity is month-on-month over the course of the last decade. And that gives us an idea. If prices were to keep rising at this level for the next 12 months, this is what inflation would be like. And I've broken those bars down into the various components. And the dark blue bars are the impact of energy prices, and the sort of grayish bars are the impact of food prices. And as you can see, over time, those things tend to add a lot of noise. They're either kind of increasing inflation or decreasing inflation, but net, they tend to net themselves out. But as you can see on the right-hand side here, since March, when we had the war in Ukraine, for the last 3 or 4 months, those things have added significant impact to headline inflation, particularly energy. It's had a huge impact on the inflation prints that we see coming out. We expect the government, central banks to look through this. We expect these things to normalize. And so we're not, although it's very uncomfortable and very front of mind, we're not particularly focused on those things as it relates to inflation. But what we're more interested in is the core underlying inflation and how pervasive that is. And again, I've got a similar chart here for US inflation at a core level this time, excluding food and energy. Again, this black line is the kind of trajectory of prices over the last decade against a sort of 2% run rate. And obviously what happened at the start of the pandemic in around March 2020 was that prices initially dropped when nobody was demanding these things. We didn't know how to spend yet. And then as we kind of figured out how to operate in a pandemic environment, we started to spend again, and then we saw prices pick up and spike. Now you'll see I've tried to break this core inflation down into a few sort of notable components. And the one that probably sticks out the most is these red bars over here. And this is the price of used cars, which makes up about 4% of the US inflation basket. So it's normally a pretty small component of what Americans are spending on. And as you can see, historically, certainly pre-pandemic, it was almost a negligible impact on overall inflation. But obviously what happened as a result of supply chains, and we weren't able to provide the chips to make new cars, this is fairly well documented, consumers still had lots of money and still needed cars. And so they started to try and buy used cars. There's obviously only a certain amount of used cars around. And so the prices of those things shot up as this increased demand started chasing those things. And you can see in the sort of second and third quarter of 2020, and then again in the first and second quarter of 2021, the impact of used car price increases was fairly dramatic on inflation. And so a lot of this excess inflation was coming from this one very specific component. And we thought that ultimately people will figure out how to make enough chips again, we'll get new cars manufactured again, and this will go away. So this was alarming. It caused prices to kick up quite a lot, but was very specific and concentrated in one area, and we believe that would likely go away. And then as we moved on from there, we saw a couple of things. Firstly, you'll see those red bars still showing up as positive, which means used car prices kept climbing. And in fact, they're now more than 60% above where they were pre-pandemic. And in many cases, used cars are more expensive than new cars. But what was probably slightly more concerning, certainly over the course of probably from the fourth quarter of last year, was these light blue bars, which is the service component of inflation. So things like housing, medical, travel, and the likes of that, which tends to be more sort of sticky and pervasive, and this was the bulk of what was making up inflation pre-pandemic. And this was kind of contributing to this 2% number. That component started to kick up in the fourth quarter of last year, and it's continued to accelerate in the first half of this year, which is uncomfortable because that stuff sticks around, and that's the concerning part. But that's kind of where inflation has come from. Where do we think it's going to from here? Because that's obviously going to be the biggest impact on our investments and our economies going forward. So again, I've got a chart of US inflation here. Again, this sort of gray line from bottom left to top right is the trajectory of prices. The bars, again, are the annualized run rate of month-on-month inflation, and the dark blue bars are where we've come from. And this was June US inflation at 9.1%. It was a pretty nasty number. But what we want to look at is where inflation is likely to go from here. And those light blue bars are kind of extrapolated from a market called inflation swaps, where investors are able to bet on where they think inflation is going forward. And so if we extract those numbers, we see that investors believe that inflation is going to be pretty uncomfortably high for the third quarter of this year that we're in now. Is going to stick around that 8.5% level. In the fourth quarter, we're going to see it start to come off, and it'll end the year still uncomfortably high at 7%, but at least heading back in the right direction. And then in the first half of next year, we see the just dramatic drop off in the price of inflation, heading back down towards this kind of 2% level, which is optimal for the US. So we're going to have uncomfortably high inflation sticking around probably for the next quarter. The fourth quarter, we'll start to see some easing. And then it's really the second half of next year that we're going to see this come off and start to normalize again, or at least that's where investors are sort of betting the trajectory is going to go. So the reason we're talking about inflation is because obviously it has a big impact on consumers and on our ability to spend and how much value we're getting for our spending. But also central banks, as kind of the guardians of the economy, are specifically tasked with keeping inflation at those optimal levels. And so they're going to have to respond to this above average inflation, and they're going to do that by raising interest rates, which should slow demand. And that's the main translation mechanism from inflation into our investments. And so we look at this because it does have an impact on our investments. And what I've shown in this chart is investors' expectations for what the central bank will have to do in 2022. So if we look at the blue line, that's the course that investors believe that the US central bank is going to take. And if we look back in sort of the last quarter of 2021, investors believed that by the end of 2022, the US central bank was going to have raised rates from zero, which it was in the last quarter of last year, to around 75 basis points. So not a particularly aggressive hiking cycle. And then you'll see expectations kind of evolved over the course of this year to the point now where investors believe that the central bank will the US central bank will end 2022 with rates at 3.5%. They've already come from 0 to 1.5% over the course of the last few months. And so over the next few months, we expect them to add another 2% of hiking to that to get us to 3.5%. And you can see that in the expectations have evolved, and we're now investors are already baking in quite a negative scenario for where central banks will have to get to. Even the European Central Bank, which had rates in negative territory for most of the last decade at least, towards the end of last year and going into the start of this year, investors were thinking that there was no chance that the ECB was going to be able to return those rates to the positive territory during the course of this year. And again, as time has passed and we've had the additional blow of the war in Ukraine and the impact that that's having on inflation over and above what was already happening as a result of the pandemic, investors are now expecting that even the European central banks will have to push rates back into positive territory, and in fact are likely to end the year at about 1% positive rates. And I'm going to leave it there, and I'm going to hand over to Nolan, who's going to talk about how that's likely to impact our fixed income and currency investments. Thanks, Nolan.
Thanks very much, Pete. I appreciate the introduction. Hello, everybody who hasn't met me before. Okay, sorry, I was fighting a computer there. Hi, everyone who hasn't met me before. My name is Nolan Wapenaar. I am co-CIO of Anchor Capital along with Peter Armitage. My speciality is fixed income. So I'm really going to take it from what Peter's Little has said and then expand. I'm first going to look and just bring you sort of a behind the scenes look at how we construct the Navigator, how we form our views, and then what that means for the fixed income-esque asset classes. I will then hand over to Peter Armitage, who will take you through the equity asset classes. But very briefly, if you look at our the market, what we generally do is in any given year, for instance, I'm looking at the Rand dollar here, we'll go and look at what does the Rand do, and say, for instance, the Rand depreciates by 5%. We'll put a little chart dot saying in this year the Rand depreciated by 5%. Next year comes around, the Rand might depreciate by 10%. Some years the Rand actually appreciates. We've seen a few of those. And over time, you start to build up this distribution of what the Rand is likely to do. And you'll find that the Rand is, the distribution clusters around about 5% depreciation every year. So we walk around, we think about it saying the Rand is going to depreciate on average by about 5% a year. And most of the time it does that. Sometimes it surprises us either with extreme depreciation or extreme appreciation. We're then able to look at the current price of the Rand and, the global macro environment and say, look, the risks are tilted slightly towards a stronger Rand or slightly towards a weaker Rand, but that's basically how we do things. The challenge we've had this year is that this distribution doesn't work. And what we've got is a bimodal distribution that says there are a number of scenarios where the Rand is actually going to be 10% weaker than it is right now. And there are a number of scenarios where the Rand will be 10% stronger than it is right now. But there's actually very little in between. So it becomes a very binary outcome depending on how things play out over the next 6 to 12 months. And that's what's made for a very challenging type navigator. Specifically, though, let's give it some names. And for a weaker Rand, what you really are talking about is a US hard landing. That's kind of a euphemism for saying that we think that US goes into a recession, and in that type of environment, the Rand is going to weaken further. We've put 18 Rand to $1 in a US recessionary environment. Alternatively, though, we've got a US soft landing. So that means that the US central bank hikes interest rates just enough to slow the US economy without putting them into a recession. They get through this, things go back to normal, and we think that the Rand goes back to 15 as part of the world going back to normal. So that's the alternate scenario. And you've kind of got to pick a lane here, which makes it very, very difficult. So what we've done is just put on the chart here, the Rand at 17 right now, give or take. And we've said, well, if we look at it, what you can say is that the Rand is definitely pricing in more of the risk of a hard landing, is definitely priced closer for that right now. And a soft landing would actually be a bit of a relief. Interestingly, though, if you go and read different research, you'll find that the sort of probabilities are measured at about 50-50 right now. So it really is a coin toss between the two. However, the financial assets are pricing in a more dire outcome. And in fact, if we look at a multitude of different financial assets, what we've done here is put them on the chart showing approximately where we think they are in the sort of continuum between a hard landing and soft landing right now. And there are a couple of things I want to take away from this. Firstly, most of the asset classes are sort of clustered towards the left. So we're pricing in more of the risk of a hard landing than a soft landing. Second point is nothing is fully on the left. Nothing is fully on the hard landing side. So if things go really wrong in the US, if things go really wrong in the global economy, there is a little bit more downside. But the point I want to make is firstly that, there is less downside. I think prices have moved quite dramatically this year. There's no doubt about that. And as a result, the downside is far less than it could have been. And what we find is that many investors are actually very focused on possibly the last 5 or 10% down on equities, the last 3 or 4% down on bonds. And they want to avoid that. But what they're missing is on the right-hand side, there's actually in the other half of the possible scenarios, there's significant upside that is now on the table if things go right. And there's significant opportunity that presents itself almost in all asset classes. The second point we want to make, just as context for the Navigator and for our asset allocation, is that we're taking a 12-month view here. So in the event of a hard landing, that probably is in the next six months or so. And by the time you get to 12 months out, you're through the hard landing, you're back on the way up, asset prices are recovering. And again, it's actually, we're not trying to pick the dip here, but there's a reasonable prospect of being on a very good trajectory within 12 months anyway. So that informs our asset allocation views. It informs our view that actually it's not a bad time to start increasing risk. You're getting very attractive assets across the board. Just looking very quickly, just to give a bit more context, in today's world, why do we think it's a 50-50 between a hard landing and a soft landing? And in terms of, the arguments for a hard landing, the honest truth is the US Fed has exactly a 0% success rate. In terms of slowing job growth, in terms of slowing the economy without causing a recession, they're not that good at it. They haven't pulled it off. That being said, they've probably got an easier set of circumstances right now. It is particularly, the corporates are particularly strong, consumers are still quite strong, and the job market is actually not terribly overcooked right now. And if they can just get a couple of corporates who are looking at expanding to slow their expansion plans, they're going to get their desired outcome. So from that perspective, we do think that there's actually is a reasonable prospect of the Fed getting it right this time around, which is why, a number of investment firms are suggesting it's probably a 50-50, notwithstanding the fact that many asset prices are actually, pricing almost a doomsday scenario right now, giving us the potential upside. Looking at different asset classes and just unpacking our thoughts a bit more. So in terms of the Rand, we subscribe to the purchasing power parity model that says that the Rand should depreciate by the inflation differential with the US over time. Thing is, that doesn't really work too well in recessionary environments. And if you think back to our last recession, COVID, the Rand spiked to 1936, I think was the high. And we do expect that a recessionary environment will see a weaker Rand again. This time around, we don't think it goes as far as it did during COVID. And there are a couple of good reasons for that. The first is that Europe has an energy problem in the context of not getting enough gas out of Russia, and they've got to substitute that for coal, which they're importing from South Africa. So this recession, our terms of trade will be better, our exports will be better, and that will be a little bit more supportive of the Rand. Hence, not 1936, but maybe 18. The other point is that last recession, foreigners sold an absolute avalanche of financial assets back to South Africans, both in bonds and equities, and that put a lot of pressure on the Rand. This time around, foreigners they didn't come back, so they don't own as many assets to sell, and we expect to see less selling pressure. Definitely have seen some, but it's far, far less than it was previously. And again, that gives us, gives sort of credence to our view that the Rand probably pushes to about 18 in a bad scenario, rather than the 19 that we saw last time around. In a good scenario, we think the Rand pulls back towards our fair range, 14.50-15 that we've been talking about. It doesn't sort of gallop there. The Rand tends to creep there. And that means that we think the Rand will appreciate sort of gradually over time. We've penciled in, for the purpose of our asset allocation, a Rand dollar at 16, which is our view that either the Rand sort of spikes weaker and then kind of comes back in the one scenario, or alternatively, the Rand actually just gradually appreciates from here back towards its fair range. So that's our Rand view right now. It's going to be volatile, but the Rand is a little bit oversold at current levels. Looking at South Africa, looking at domestic fixed income, what do we think? So very, very quickly, the first thing we think is that rating agencies have actually been a little bit more positive on South Africa. So we've seen outlook upgrades from negative to sort of neutral, and a couple now actually looking positive, which was unexpected. This is a function of our debt levels are less than previously. So, a couple of years ago, we were forecasting debt pushing 92% of GDP. We're probably going to come in at 70%. Ironically, a little bit of inflation is good because it does inflate away our debt as well. So it does help a little bit in the short term, but not too much. So overall, the dynamics are looking a little bit better. Domestic inflation is another factor that's actually quite positive for South Africa. South African CPI is being released at 10 o'clock today. We expect it to come out at about 7.3, 7.4%. Contrast that to US inflation at 9.1. Our inflation at 7.4% is just above the 3 to 6 target band that we have in South Africa. The US is running at 4.5 times the inflation target of 2%. So we are in a far, far easier position. Our inflation pressures are far less. A function of, self-reliance, I guess, on coal, a function of self-reliance on food, etc. So we definitely are feeling pressures, but not to the extent in many of the other nations. And that gives us more of a support base for our bonds. And then finally, what do we think about Eskom? We can talk about interest rate hikes and the impact on the economy. The truth is the single biggest impact on the economy is Eskom. I think Eskom 2.0 is a little bit of a hair-raising thought, and I'm kind of reading as more of a political gambit than a sort of realistic prospect, but we'll see how that plays out. Either way, what we do think is that the pressure is on the government. We've already seen liberalization of electricity rules. I expect there will be more, and that over time this will get fixed. But yes, for now it remains probably the single biggest concern that we're focused on. Looking at South African bonds, though, what's happened? Well, as we've gone through this crisis, what we've got here is a chart that shows you the yield on the South African 2030 bonds, the bond maturing in the year 2030. And you can see how the yield has been relatively stable around the 9%. And then since about September last year, the yield has been on an upward trajectory, i.e. the bond price has gone down. Bond investors have seen capital losses, but the interest rate that you're able to actually lock in by buying the bond now goes up and up. And we've gotten to the point where the interest rate on that bond is actually the highest it's been absent a couple of weeks at the peak of the COVID period. And that becomes incredibly compelling as a yield. Where are we at in terms of yields? What does this mean? Well, it means that if you invest in the Anchor Bond Fund, right now you're earning almost 12% per annum. So you're earning effectively 1% per month as sort of interest income. But against that, you've got capital, you will have capital volatility as the bond price goes up and down. The bond price has been going down of late. So unfortunately, that your interest income has kind of been negated by depreciation of your bonds. But you're getting to the point where, the bonds are actually so cheap, it becomes difficult for them to depreciate further. And if we look out 12 months' time, we actually think you're in a position where the bond fund should yield 1% per month of income, and there should be some capital gain as bonds recover to more realistic prices. Alternatively, what we look at is the flexible income fund, which says buy, mixed bonds and cash such that, I can participate in the upside, but that if it goes wrong, I should see far less downside. So it's designed to not make a loss. It's almost designed to be a sort of steady eddy capital preservation fund with potential upside from the market. And then what we've also been seeing of late is with interest rate hikes, we expect another 0.5% towards the end of this week. We expect on top of that, another 0.75% through to the end of the year. We are seeing that that's making core income quite attractive. And by the end of the week, we think it's going to be yielding 6.5%. Steady eddy, it behaves like a bank account, no volatility, you just earn your monthly income. So overall, the rising rates make it a very attractive time for fixed income, and that's what we're trying to bring through in our documents. So bonds are cheap, we expect volatility for the next while, and that's a great entry point if you're taking a 12 to 24-month view. Looking at global fixed income, we think that the world is precariously balanced. So the idea is that the Fed will hike interest rates until such time as things slow down, in order to slow the US economy. We're kind of at that point. Share prices are saying we're at that point. Economic data is showing we're at that point. The economy is clearly slowing down, and that means that bond prices are sort of high enough. You don't need to go further. We're having the desired effect. And that's great. So with yields around 3% on the US 10-year bond, we're achieving our objective of slowing the US economy, and the risk is almost that we slow it too fast. So in the context of US bonds, what we've got here is the same chart showing the US 10-year bond yield over time. You can see how the bond yield is pushed up to about 3%. Against that, you've got Anchor's forecast over time of the red line of where we think the bond yield should be. And you can see for the next while, we think the US bond yields should be at about 3%, really reflecting our view that they're high enough that the economy is actually in a position where it is slowing down. And then, as inflation starts to come off, you don't want to keep slowing the economy, and you will expect to see some interest rate cuts next year. We can debate the timing and the magnitude of those as such. But the point is that US bonds are actually offering attractive yield for the first time. And again, there's a reasonable prospect of yields coming down in the sort of medium term. So from that perspective, looking at global bonds, again, it's great that they're offering yield. It is going to be volatile for a while. Corporate bonds are even more attractive. That's a good entry point. So for the first time in a while, actually, offshore portfolios are able to take advantage of offshore income products and generate attractive returns. So overall, it's been a bit of a challenging journey to get to this point, but market pricing is such that we think financial assets are actually quite compelling today. With that, I'm going to end my presentation, and I'll obviously take questions at the end, and I'm going to hand over to Peter Armitage. Thank you.
Right. Good morning, folks. It's great to be chatting to a nice, healthy audience out there. We've got close to 1,000 people listening to this webinar, so times have certainly changed. We sit in a room and talk to a massive crowd, whereas this normally would have been 3 or 4 presentations around the country. Right, I'm going to cover the equity section of things. I think it's important just to put in context exactly what's happened out there. We've had the worst first half of global markets since 1970, and almost everything has lost a lot of money. SA has been a reasonably good place to be, but the only places that you could have made money is really US dollar cash and energy shares in the US. So depending on what index you look at, returns are down 20 to 40%. People who've been in growthy tech type opportunities have suffered the most. And this is where we're coming from. Importantly, it feels like a pretty uncomfortable time to invest. And over time, that is when you make money. When things are feeling very comfortable and they tend to be well and fully priced. When things are uncomfortable, it's because there is uncertainty. And really our job and assessment is to assess what's priced into markets. So what we've said here is the optionality is building for great outcomes if it's not as bad as the world is talking. The consensus expectations are pretty low, and we think a lot is priced into the market. We are, however, at that uncomfortable stage of the market where you've had that kind of 20, 25% drop. And in reality, nobody knows whether there's another kind of down 5 to 10% spike before it comes up, or as people were suggesting last night, every time the market goes up, they say it's found a bottom. The rational thing to do is to look in 12 months' time, as Nolan said, and try and assess where businesses and the market will be. So our conclusion from a domestic equity point of view, and domestic SA shares are in a completely different space to global shares. We're largely driven by China in terms of our commodities and NASPAS process. And currently there's a tug of war between the US recession story and the Chinese stimulus story. But we think the Chinese stimulus will be strong as we go into the second half of the year. And domestic shares are very, very cheap. From a global point of view, it's the exact opposite. The market's been going very, very far and very fast. Valuations got pretty high. They've come down quite significantly. I think if we look at index level, we're not yet ready to say that bargain kind of bang the table valuations, but they certainly are in cheapish territory. There's every prospect of one more leg down. And there's, a lot of people are talking about earnings being downgraded, which I think is inevitable. But in the last few days, you've seen companies come out with results even a little worse than expectations, but share prices go up because people were terrified that suddenly everything had fallen off a cliff. And that doesn't seem to be the case. A key point, and really the theme of my presentation from a global point of view, is that there's great 12-month entry points in specific shares. So it's not so much about buying the index. There's some great companies whose valuations are the lowest they've been in many, many years. So this is the table you saw earlier. we're talking about a 15% 12-month return from domestic equities. And from a global equity perspective, we're talking 10% in dollars over the next 12 months. And if we have a soft landing, that could be considerably more. Bearing in mind that's not hugely bullish, given that we've come from kind of 20 to 30% down. Just one slide to put on the table. At times like these, it feels very uncomfortable. Don't lose the faith in global equity markets. You want to be invested in growth businesses over time. Those have and will continue to deliver the kind of 8 to 10% dollar returns. But if you want to get that, you do face, and even on this graph, they fade into small blips. But each of these drops was as painful as what we're experiencing now, but the market does come back. And just to remember, we're in an economic cycle. And it's a case that really all of us kind of market strategists and people looking at markets are trying to assess where we are and what's priced in. We're now firmly into a bear market in the US. And we think the average bear market lasts about 12 months, which would imply, kind of a bear market through to the end of the year. But then things get rosy again. At some stage next year, interest rates will start coming down and we'll kind of be back at the races. If you look at that table and put China and the US, it's important to understand that China is the US is much further along from a cycle perspective. And South Africa is still going to benefit over the course of the next year from China stimulating. So the world has changed around completely from where it was a year ago. A year ago, growth companies, which had high growth rates, were trading at high valuations. People were happy to discount well into the future. Right now, there's no credit being given for being a secular growth company or having, kind of pricing power and being a quality company. So that's really where the opportunities sit. On the other side, and I've got a few slides to show you, people where they feel comfortable, and that's sitting in utilities, in oil companies, in coal companies, in defensive US businesses. A lot of those haven't come off at all, or in fact, up quite considerably on a year ago. So that isn't where the opportunity to make money sits over the next 12 to 24 months. And we've got to be biased towards the left-hand side, and the left-hand side is where it feels more uncomfortable. World GDP growth is still forecast to be at a reasonable rate over the next few years. The 2022 number will probably come under some pressure, but then we'll get back into, and this is why you want to be invested in equities over time. The world tends to grow at kind of 3.5% per annum. And on that stage, there's companies that can grow their profits by 10% plus in dollars. A significant factor in global markets at the moment is the dollar. And this chart is quite alarming. The dollar versus the euro, 123 a year ago, and now sitting at parity. It's bounced back a little bit. So this is a significant factor. If you're sitting in Europe and you're exporting to the States, you're getting 20% more for your products. And if you're sitting as an American business, which is bringing across profits from Europe, bringing in 20% less dollars. So an example of that, last night I was listening to the Netflix conference call. All of their costs are in dollars and 60% of their revenues are outside of the dollar framework. So that's one of the challenges. And we've got to look at all businesses just to check what their risk is from this perspective. And obviously there's some nice opportunities that arise from any dislocation in markets like this. So markets look cheap to reasonable. The S&P is at a forward 16p multiple. At a forward 15, we would say very cheap. So it's, a lot has been priced in, but there's still some defensive shares and energy shares that are holding up overall valuations. Average growth from US companies, the red line is about 10% per annum. We're still going to have a strong growth year this year. Lots of companies still recovering from COVID last year, but then probably slowing back down to the 10% level. And there's every risk that in the short term, that can go down or negative for a short time period as the dynamics that my colleagues have been talking about come to pass. So this is the world forward PE multiple chart. So the average over the last 20 years has been about 16. We're now getting down to 15 on the world PE. And you can see over the course of the last 8 to 10 years, it's been a pretty good buying opportunity. Things have tended to bounce from there. The risk is earnings will probably come down a little bit more, which would push the PE multiple up. And that's kind of what we're grappling with in terms of reaching conclusions. I've got a technical chart here that I'm not going to go through in detail, but for those of you who are familiar with the equity risk premium, at the moment you get 3% on US bonds. If you invest in US equities at a 16 PE, you're getting a 6.3% earnings yield. So what that means is going into shares, if you invest $100, you're getting $6 of earnings, which is 3.3% more than buying into a no growth but low risk asset like the US government bond. So what we're concluding is that you are being given the excess return that's justified, but this isn't particularly cheap. It's kind of been the average over the course of the last 10 years. I then want to just spend a few minutes looking at one company, which I think explains a lot of what's happening around the world and the company dynamics and why it's difficult to just look at things at an earnings level. So Nike for us is the poster child of what's happening out there in the world. First of all, it's a best of breed, high quality growth business that we want to have in our portfolio over time. The share price went up to $180 last year and is now down to just over 100. So it's just past the pre-COVID level. So what is Nike experiencing and why? First of all, if you look at the bottom part of the chart on the right-hand side, Nike has given you an 18% compound growth per annum over the course of the last 10 years. So that's the kind of return you want to be invested in. Nike was, we think it can grow at 15% per annum over the course of the next few years. But in the last period, it's been impacted by all the things that are putting pressure around the world. So supply chains have been snarled up, which means it hasn't had enough product to sell to the US customer. So in the last quarter, the US sales were down 5%, and then they got a lockdown in China. Nobody needs running shoes if you're locked in your apartment because of COVID. So there, the sales were down 20%. And because of supply chain issues, they've got 65% of their stock in transit. So their profits are flat this year, and they're not growing their profits like they did in the past. However, all of this obviously reverses. And going into the next year or two, China will normalize. The supply chain will sort its issues out. There'll be much less stock sitting on ships. They'll have enough product to sell to the US customer. And we think the company's earnings can kick up about 20 to 25% to get to normal levels. So this is, when we talk about earnings growth out there, there's in fact great companies that aren't growing their earnings this year that have got much better prospects for next year as the issues around the world normalize. So, China, if you look on the right-hand side, is normally a 20% growth market for them. Over the course of the last year, it's been minus 20. Then I'm just going to look through a few individual shares, which I think probably tell the story even better than these index levels. So first of all, defensive and safety shares have done very well, and in many instances haven't declined at all. So our argument is, we've had quite a few of these in our portfolios, and the argument is whether to now switch from these kind of defensive shares into companies that clearly have a lot more upside. So Coca-Cola has been a 20 to 25 PE multiple share over the course of the last 4 years and remains there. The price has come under no pressure at all. Johnson & Johnson, which you've got in our portfolios, grown nicely and steadily from $100 to $180 over the course of the last 7 years. The blue line is the PE multiple, and you can see people have taken solace in companies like this, which are less likely to be impacted by higher interest rates. So there might be a bit more of it to run, but these are not the companies that are now the opportunity. If we look over in China, Tencent, the red line showing the PE multiple is kind of close to the lowest it's been over the last 10 years. It was up at a 30 PE multiple if you look back 18 months ago, and now down to a 20. Apple, which kind of fits somewhere in between. So it hasn't been devastating, although the share price is down probably about 20%. But people got, as interest rates got pulled back and everything got stimulated, things did get overvalued. So Apple got up to a 35 PE multiple back in 2020, but it's come back down to a very reasonable 20 PE, back to pre-COVID 2019 levels. And it's a share that we'd be happy to start nibbling on. Richemont, again, a lot of froth coming in 2020, got up to a 32p multiple, now down to an 18, which if you look at the red line, is kind of in line at the bottom of the range. So great quality businesses with excellent pricing power, now giving you pricing opportunities, which you haven't really had on the table over the course of the last 5 or 6 years. Disney, what I'm showing you is the share price. In 2014, the price was $100, and it's again $100 today after almost reaching $200 if you look back a year or two ago. So for us, Disney is a much more valuable business than it was 7 years ago. It's created a digital subscriber base of over 200 million people, and that's growing fast. We love brands like this that can continue to leverage off their brand for many, many years. And like I said at the beginning, businesses with kind of a secular growth story and an exciting future growth story aren't being given the credits and present some nice opportunities. Microsoft, again, you can see the theme coming through. Back in 2020, got up to a 35p multiple. The valuation's now back down to 4 or 5 years ago. So on the basis of actual shares, there's some quite compelling opportunities as to why you would get invested now. Alphabet, which is Google, is at a forward 15p multiple. Its average over the last 10 years has been 20 to 25. In 2020, it got up to 28. So this is an advertising company. It will come under some pressure as the circle turns, but you want to buy businesses at the bottom of the cycle at low valuations. That's when you make a good compound return going forward. The bank shares are looking very cheap, low price to books, earning nice returns. It's the lowest PE multiple in years, sitting at about an 11 PE. And again, as these things move through the cycle, there's some nice opportunities. Meta or Facebook is more of a company-specific opportunity. It was at $150 4 or 5 years ago. It's $150 today. It got up to, it's $400, and now sitting at a 13 PE multiple. So, I mean, that's kind of the summary of global markets, and I think best expressed by actual shares and share prices, because just looking at index levels doesn't tell the whole story. So we do think a lot is priced in. The market's been bouncing for the last few days. What we're saying to people back at the office is don't get too excited on up days and don't get too depressed about down days. There'll be a lot of volatility to follow, but we've shown you some indications of share opportunities. From a local market perspective, as we explained, very different drivers to global markets. Global markets got very expensive and interest rates are going up. From a local market perspective, shares started at very cheap levels. There's some amazing value out there. And there's really 3 drivers to our market. One is commodities, and we think Chinese stimulus will kick those up again towards the second half of this year. And those companies are now trading at quite nice values after some quite significant pullbacks. There's been a game changer in Naspers and Process, and I'll show you a slide on that. And we think the prices that the banks are trading at mean you'll get about a 15% return. So over the first half of the year, the capped SWIX was down 10%, much better than global markets, but obviously still not great, with Naspers being the only real notable contributor in the second quarter. So this is how we stack up our returns. And you can see the nice returns coming from the bank sector, from Richemont, from diversified miners and the like. And one of the things we noted when we were compiling this and debating this internally is we're not actually forecasting a negative return from any sector. And a lot of that is because cheap valuations. So from an Naspers Process perspective, which is incredibly important for our market, given its size, it was really a lot of the discount to NAV, which I've now circled here, which is still at 52% after getting up to 70, was driven by the fact that their major asset, which is 80% of their asset base, which is Tencent, they could never unbundle and got a sporadic permission to sell shares. The game changer of a few weeks ago is they've been released from the restriction of selling shares and have agreed to do it on a measured basis with some kind of formula that we don't know in the background. But what they've committed to is if they sell 10-cent shares, they will then use that money to buy back their own shares. What that means in substance is that they're selling something for 100 Rand and on the same day buying back effectively the same asset for 50 Rand. And they're going to do that day in, day out for the next 3 years. So we think that the maths of that at a per share level will increase the net asset value by about 10 to 15% every year for the next 3 years. So on top of whatever happens to Tencent and the rest of its businesses, you can add another 40 to 50% to the Naspers value per share over the course of the next 3 years. We think that will also probably have an impact on narrowing the discount further. So we think there's been a real game changer in this share. And we did see a 40% return from Naspers in June. We were well exposed to it in our portfolios. We kind of saw a version of this coming, but not exactly this and not as positive. And so, you could well see it pull back a little bit in the short term, but we think an exciting story. Then just to focus on the banks here, the dividend yields that I've circled. You've got these big banks trading with the extreme being Absa at a 9.5% dividend yield. So typically 6 to 7p multiples, 8 to 9% dividend yields with fairly resilient growth stories for the next year or two. You can see why we think these will make good investments. So to sum up the view from an equity point of view, domestic equities came from low valuations. The market's fallen somewhat, and we think there's pretty good prospects over the course of the next 12 months, not because of the SA economy, but because of the China driver into our market. Chinese stimulus, we think, will be very strong going into the second half of the year. That will drive our commodities, be positive for Naspers, which has got its own dynamic, as we identified. And domestic shares are very, very cheap. From a global equity point of view, a lot of bad news is priced in. It's feeling uncomfortable. We don't know when the bottom is. But if we think, you can buy great companies at good prices, and if one just, simply takes that approach, we think there are great entry points if you take a 12-month view on shares. But we certainly can't give you an assurance that you're not going to have a last little spike downwards. If inflation doesn't indeed peak in the next 2 months, as Peter Little suggested, that gives a lot of foundation to the story that we're telling. So that's the equity side of things. I'm now going to hand over to James, who's going to tell us a little bit about technology.
Morning, everyone. So, morning, everyone. My name is James Bennett. For those who don't know me, I've been in the market since about 1994. I was on the sell side with the global investment banks for about 23 years, and then more recently on the buy side. Okay, so we just wrote this piece about whether now's the time to be in technology shares. And we're coming at it more from the angle, not of whether now is the time to be double or triple overweight tech, but whether you should be in tech at all. And certainly earlier this year, when the global tech shares were the first ones to really get hit very hard, sort of the popular press was starting to ask the question about, whether this is all just a big bubble, whether now is actually the time just to be getting out of tech. It's not going to be the winner for the next, 10 to 20 years. And we think that that's a huge mistake. This is a big sector. There's a wide investable universe of very profitable, innovative companies with great management, businesses that can really scale. Yes, there will be some, failures in this sector, but we think, especially with the sell-off now, that there's a very sort of fertile hunting ground to pick some really good quality companies. So I think the first thing to say is that if you're going to go down this route of, now is not the time to be in tech, bear in mind that if you look at the S&P 500, technology, however one actually defines it, is the biggest sector in the market at the moment, and it's about 27% of that index. Bear in mind as well that what we sort of popularly refer to as big tech, some of these companies are not even included in that S&P 500 tech index. So the 4 companies that are not actually in there, Alphabet, Amazon, Meta, and Netflix, if you were to include those, tech would actually be about 36% of the S&P 500. And there's about 80 of the 500 companies that are actually classified as tech by them. So it's a very, very sort of wide universe. I think the next question that people have been asking as well, is this just all a big bubble? People obviously, remember that what happened in the late 1990s. And I think the answer is that this probably isn't really a repeat of what happened back then. And what this chart shows is that 27% of technology as a percent of the current S&P 500, how that number has actually trended over time. And the reality is that it's been sort of a 30-year a secular trend. And if we think of how pervasive technology has become in our lives over this period of time, it stands to reason that this would be reflected in technology's rising influence in our investments as well. I think one of the differences now too is that, albeit that some of these companies were clearly overvalued 12 months ago, we think there'll be a lot less tech failures than was the case in the late 1990s. I mean, I was in the market back then. I remember some of the really rubbish companies that were listing globally. They didn't really have sort of proven business models. They were really just kind of selling a concept to the market. And obviously, some of those companies failed very quickly. Whereas a lot of the companies we see today have very, very sort of proven business models. The next thing, just on valuations. Now, bear in mind that Apple and Microsoft are about 45% of this S&P 500 technology index. We wouldn't say that you're in sort of a deep value territory right now, but there has been a very sort of decent pullback. So those concerns about valuations 12 months ago is definitely not the case where we're sitting today. And in fact, if you had to look at just sort of the mid-cap tech index, those companies have derated very significantly back to where they were in 2014 to 2018. I think one of the questions about technology as well is when people say, well, you shouldn't be in tech. And the answer to that actually is with a question is, what do you actually define as a technology company? And I think the definition of a technology company has become increasingly broad over the last few years. And bear in mind that a lot of what we call big tech today, there's actually a more traditional business underlying that company. And a lot of what we say is a technology company today would have been classified as something different 20 to 30 years ago. And we just ask these questions here, Apple, Google, and Amazon, are these just tech companies, or is there actually a more traditional business underlying these companies? And Apple's an interesting one. We know with Berkshire Hathaway that for many years, they didn't invest in technology companies. And when they bought this big stake in Apple, which is by far and away their biggest holding in their equity portfolio, a lot of people said, well, they've dialed back on this view of no tech. And I think probably the answer there is that they view Apple more just as a consumer business and just a very, very high quality consumer business. Yes, Google has a lot of technology in it, but underlying all of that is an advertising company, but a new way of doing advertising where it's very targeted, very, very cost effective and very scientific in the way it's done. And again, on Amazon, sure, there's Amazon Web Services, which is very tech orientated, but Amazon underlying all of that is just a retailer, but doing it in a new technology enabled way that's highly, highly efficient. So what, we say of Amazon big tech today is probably the Walmart of 20 or 30 years ago. Some of the other things just to bear in mind as well is that 20 years ago, a lot of corporate tech spend was sort of kind of just a grudge purchase. It was a cost center, whereas a lot of the spend today is a lot more defensive. It's a lot more mission critical for these companies. So if you look at these SaaS tech companies or software as a service tech companies, they even publish some studies where they show that spending on their products, how it actually increases corporates' own performances. And even if those numbers are somewhat exaggerated, I think, the truth, even if they're 50% true, it is just the fact that in this, world of high inflation, companies trying to protect their margins, that a lot of this tech spend is very important. I think the other thing to bear in mind with technology companies is that investors often get caught up on the valuations of these companies, especially earlier in their phase. And the thing to bear in mind with tech is that it is enabling these companies to scale a lot faster than was the case 20 or 30 years ago. And 20 or 30 years ago in the more, traditional brick and mortar businesses. So think back to an example like Starbucks. It started in Seattle in Washington state back in 1971, slowly started in their own state. Then they had to slowly try and expand across into other states. They went into Chicago. It wasn't successful initially. What they didn't realize, is that the weather's different. They weren't putting double doors on the store. And so you slowly have to dial back, find out where it's going wrong. Whereas tech companies scale very quickly across state in the US, and then they scale very quickly across global borders as well. So a lot of, tech companies that maybe started 20 years ago in the US today have got 50, 60% of their sales outside of the country. And I think one of the things about tech companies as well is that in the earlier phases, they always look very expensive. I think that's where maybe some of the more value-based strategies really struggled with these big tech companies, 10 or 15 years ago. And what we've seen is that these companies that look expensive at the time have shown an incredible ability to grow into those stretched valuations. Now, with this, obviously comes risks as well, that, investors have recognized that these tech companies can scale very quickly. And sometimes you do get overvalued situations. The growth doesn't come through and it all ends in disaster. But when it comes to valuations, we really do just need to keep an open mind on these companies. But again, bearing in mind that a lot of these stocks have derated 40, 50, even 70% over the last 12 months. I think those valuations are much less of an issue now than they were a year ago. So, again, really our conclusion, it would be a mistake to just avoid the sector. These sell-offs always create good buying opportunities. As Pete said, it's about looking at it at a stock-by-stock basis rather than just taking a big top-down sort of sector view. And this pullback has created some interesting opportunities. So in our conclusion, within a balanced portfolio, tech continues to earn its place. Thanks, everyone.
Okay, thanks, guys. Got heaps of questions here. We're probably not going to have time for all of them, and I'll try and if you guys maybe want to put your screens on as I transfer the questions through. Trying to basket a few of them through. I'm going to start off with, there's a very interesting question which I'm going to pose to guys and ask you to answer it, give you a little bit of time to think about it. If I can put 1 million rand into one anchor fund, which one would it be? Which is an interesting question on the chat board. So I'm sure Nolan will pick something out of fixed income. James, you can decide, and Pete's a little the same. Obviously we have across the anchor range, we've got lots of funds that express the opinions that we're showing today. The anchor bond fund Nolan was talking about. Across the equity space, we've got local and global, and balanced funds, which take a more defensive and diversified view of the world. Nolan, so I'll come back to that, but Nolan, maybe to start with you, there's a few questions around inflation and interest rates in emerging markets. So, as the dollar gets strong and emerging market currencies weaken, what is that for central banks to do? It certainly brings more inflation into those countries. That's where we're sitting in South Africa. What happens to bond yields as interest rates go up? Don't they also have to kick up? If the Fed increases by 100 basis points, what does South Africa do? Does it put more pressure on South Africa? So maybe just talk a little bit around that whole framework of interest rates, currencies, and emerging markets.
Thanks, Pete. A multitude of questions in there, actually. The reality is that the world is in a high inflation environment, and that means that interest rates are going up. Interest rates, the run rate of interest rates is probably going to be higher this economic cycle now than it was last economic cycle. And that's just a function of what's happening in commodities, what's happened elsewhere. In terms of emerging markets, if you look broadly speaking, across EMs, both in Africa and LATAM, et cetera, maybe excluding the Asians, what you will find is that the inflation basket tends to be heavily weighted towards food and heavily weighted towards cost of transport energy, petrol, oil. Now, that is absolutely horrible for emerging markets. And then, oil prices in dollars as well. So you kind of get a double whammy of a higher oil price and a stronger dollar, putting pressure on the yields. So global consensus, and it's been for almost 6 to 12 months now, is that emerging markets across the board are going to see this sort of inflation surge, inflation spike from these sort of push factors that is going to put pressure on their central banks to hike interest rates. And, barring one or two really curious ones, what we're seeing is that take place. Broadly speaking, you've kind of got a bunch of central banks that got ahead of the curve. Brazil is probably the one that got most ahead of the curves. They hiked first, they hiked furthest. And actually, the chatter within emerging markets is Brazil maybe getting to the point where they might start cutting already? South Africa also hiked quite early, etc. So, the emerging markets that moved earlier are actually in a reasonable position. Our inflation really isn't out of control. It's going to spike up now. Petrol is modeling that petrol price will come down next month by about R2.80, depending on what happens to oil price over the next couple of days. So all of that sort of triangulates to some EMs are actually, responded. It's not too bad. The emerging markets that did nothing, Turkey is a prime example, sitting with inflation now. I think it's 76% off the top of my head. And those emerging markets are in quite extreme pain. The other emerging markets that are actually probably feeling this the most are the emerging markets that are pegging their currencies. So basically what they say is, if I've got 1 rupee, it is worth $1, and you can come to the central bank and give me your rupee, I'll give you $1. That's exactly what Sri Lanka did until the central bank ran out of dollars. So those pegged currency emerging markets are the ones that are going to feel it worst. Bringing it back home, we moved relatively early. We don't have a pegged currency, so the rand dollar gives a massive stress relief, and actually our inflation is under control. So differentiating between emerging markets, I actually think that South Africa is going to come out of this quite strongly, if I can put it that way. But yes, interest rates are going to be higher. So if last cycle prime was 9.25%. This, next cycle prime is probably going to push 9.5% to 10%, and that's just a function of the world economy we live in.
Okay, and I think people battle with the concept, Nolan, from a few questions coming through on if interest rates go up, don't bond yields go up? And if not, why not?
So the Reserve Bank hikes interest rates, but the repo rate is the overnight interest rate. In other words, it's the interest rate that a bank pays to borrow money for one night. And then tomorrow, the bank has to go and refinance that loan. When you look at bonds, these are, 10-year loans to the SA government, and 10-year interest rates can behave differently to overnight interest rates. Usually they move in parallel, so you'd expect if the repo rate goes up, everything else goes up as well. But what we have seen in the last few months, and you saw it actually in the chart I had up, is that bond yields have, in anticipation, sort of risen already. So your bond price has risen, and we're almost in a situation where you're waiting for the Reserve Bank to now catch up to where the bond price is. So, what happens if when the Reserve Bank hikes later this week, let's say they hike by 0.5%, actually it's a bit of a relief for the bond market, which is worried that the Reserve Bank is too slow, and, we don't want to be in the Turkish situation. So strangely enough, with the Reserve Bank now to catch up to what the bond market is thinking is a great thing. Interest rate hikes right now are actually quite well received by the financial markets, which continue to see this more as the Reserve Bank acting credibly rather than, a shock to the system. I think higher interest rates are baked into everyone's expectations by now.
Okay, then let's go back to that previous question. You've got 1 million rand, you can put it in one anchor fund. Let's start with you, Nolan.
Okay. So my first comment is, well, I've got a couple of comments. I was going to say hi, Harold, but we won't do that. The first comment I've got is a single asset class is never a great idea. I believe in diversification. That being said, gun to my head, I'm a more conservative guy. That's why I do fixed income. I'm going to go for the Anchor BCI bond fund. And I'm going to do that because I love earning 1% per month interest income. And I really do have a reasonable prospect of, an additional 5-6% capital gains in a year's time. Yes, there are places I could do, I could do more, but I've got very, very limited downside from these levels. And hey, if it turns out well, I've got 18% in the bank. Thank you.
Peter Little, 1 million rand, one Anchor fund. What's it going to be?
I'm going to go with the managed fund, and I think there's a few reasons for that. I think, like most of us have indicated, that we're likely in for a pretty volatile next few months. So if we're looking with a 12-month horizon, it's going to be kind of hairy for the next few months, and then coming out of that, probably more exciting. And I think just the diversification that you get from a multi-asset class fund, and the ability to kind of sit around in fixed income, where both globally and locally you're getting pretty chunky incomes for the first time in a decade or so. So you can sit around in conservative asset classes waiting to deploy. You're getting paid well for that. And then as these opportunities that both Pete and James talked about in the equity market start to unfold, probably more towards the back end of this investment horizon, we can start allocating to that. And frankly, the rule that allows us to now allocate more to offshore assets in these Reg 28 environments helps us to be able to find more of these opportunities offshore. So I'm going to go with my 1 million in the managed fund.
James Bennett, where you put?
Yeah, sure. Okay, so the first thing I always say with this is, if you were living anywhere other than South Africa, what % of your assets would you put here? And the answer is probably quite low. So for me, I always just like the sort of the global offshore exposure. I think your investable universe is, absolutely huge. Your quality companies you can invest in is great. I'm also not such a big fan of sort of theme funds. I think, sometimes it's okay when you go into those, but then over time, you suddenly find the market's tilted away from that theme. So I like funds with big, wide global mandates where you're not pinned down into one asset, sort of one region or anything like that. So for me, just the Anchor Global Equity Fund with a good wide mandate, sort of a set and forget investment is where I would go.
Thanks, James. Okay, that leaves me at the last bit. I think I'll follow our asset allocation. So put in our SA equity fund. We're talking there about a 15% return. If China turns out well and we don't have a massive US hard landing, that can give you a 20% plus return. And there's a very strong dividend underpin. There's a dividend yield in that portfolio of about 5.5%. So much like James, certainly longer term offshore is the place to be, if for no other reason than diversity and range of opportunities, but also SA is a 1% GDP growth story. The world is a 3.5% GDP growth story. But for the next 12 months, I think global markets can still be wobbly. I was trying to choose between our global technology fund, because I think a lot of those things are looking pretty cheap relative to their prospects. And for many companies, the long-term prospects haven't got any worse, but prices are 30-40% cheaper. But I'm going to go with our asset allocation view and put it in the SA equity fund. We some questions on Pete. I've talked a little bit about it, but this is the key question that goes around in global markets at the moment. P ratios are cheap, but what about earnings drivers? So aren't consensus numbers too high? And does it mean that the market, in fact, isn't as cheap as we think? Do you want to have, I've talked a little bit about that, maybe just to hear your perspective.
Yeah, I think sort of there's broad consensus that the earnings numbers, I think if you look sort of 12 months out at the global level, we're probably expecting in analyst forecast, you've baked in kind of teens earnings growth. And that's seeming more and more unlikely. We are obviously still coming off a low base, so consumption is still lower than it would have been if we hadn't had the pandemic. So we are coming off a low base. Consumers are in good shape, but as this inflation kind of narrative overrides things, and central banks are forced to try and destroy some economic activity to get inflation under control. Obviously, corporate earnings are just a function of economic activity. So they are likely to have to come down a little bit. I think what we're seeing is there's so much uncertainty at the moment that it's very difficult for analysts to sort of figure out what's going out 12 months. So we're seeing a lot of focus on this earnings season. So there'll be a lot of focus not only on what companies have done in the second quarter, which US corporates are now reporting, but what the guidance is for going forward in terms of how the costs are impacting people, how robust the consumers are still in that situation. And I think we'll see earnings forecasts probably adjust over the course of the next 6 weeks as this earnings season plays out. But I'd say that the fact that sort of valuations have almost kind of adjusted to below average level is investors have already factored that in. I mean, markets are ultimately forward looking, and just because, we don't actually have to wait for the analysts to go down and downgrade these earnings expectations for that to filter through into the prices. So I think a lot of the price action that we've had year to date is a function of people are already anticipating these earnings downgrades. So it's not really new news per se. We do think they'll come down, but we don't think the market will be necessarily shocked by that.
I think for me as well, that sort of that broad sell-off has probably already happened. So from here, the risks will be in like individual stock by stock cases where you might get an individual company that comes out with a big earnings disappointment and that individual stock falls. But that sort of broad sell-off to price in the risk that sell-side analysts' earnings forecasts are too high, for me, is probably mostly done now.
James, maybe if you can continue. James had a background. He was the number one resources analyst in the country for many years. He's more recently, or for quite some time, focused on global shares. But there's a question on, commodities in this current environment. Are commodities still a good long-term investment? And then there's also a more specific question about platinum and gold. Maybe you want to have a go at...
Yes. So I think the sort of the joke we always used to say with miners is that you rent them, you don't buy them. These companies are not great sort of long-term buy and hold type of companies. They tend to not have the return on capital employed that you get with some of the really great global businesses. And you can sort of almost draw that analogy, because you're investing in finite resources, there's a lot of cost pressure. It's very capital sort of intensive mining. They tend to not make sort of good, a long-term businesses. What we also saw as well is that in the late 1990s, a rising interest rate environment was actually very good for global commodity businesses. The difference then is that the shares were really, really bombed out. Whereas this time around, the shares were bombed out in kind of 2015, 2016. So you'd already had quite a good run in global mining business running, up until now. And sorry, that analogy that I just wanted to give, imagine investing in a Pick and Pay and buying the share, knowing that you've got 100 stores and 5 stores have to be closed down every year for the next 20 years. It wouldn't make it as sort of the greatest investment. So I think with these mining companies, one has to be opportunistic. They're not the kind of stocks you're going to buy and hold for sort of 10 years. It does feel to me that we are fairly late in the commodity cycle now. There might still be some trading opportunities. It doesn't mean everything's a sell right now, but the real buying opportunity for me in mining was 5 years ago rather than 2022.
Question on China equities. Pete, maybe China and Asian equities, just from a kind of macro perspective. I can add a little bit to it.
Yeah, so I think Pete, you've had a slide up on it. We think China is probably much earlier in the economic cycle than the US. They've already come off pretty hard. they've added to that this kind of regulatory uncertainty towards the beginning of 2021. You started seeing them roll out their next 5-year plan, which included all sorts of pretty altruistic outcomes that they're expecting to achieve over the next 5 to 10 years, which didn't necessarily align with the sort of profit opportunities for some of these tech companies. So we've now sort of had to realize that perhaps these companies need to have a slightly lower rating than companies listed in other DMs, because you do have this regulatory overhang. But a lot of that is already in the price. And China have had 2 quarters of negative growth. Their second quarter growth came in much lower than expected. And they've set themselves a target for 4.5%, for 5% for the full year. So they've got to go some in the second half of the year to get there. And as a result, we're expecting a pretty significant amount of stimulus to come through. And that's obviously, pretty good environment for equity investors. Not only will it likely boost economic activity there, but it'll also boost the money supply, both of which should be pretty good for Asian equities. Although we still don't see them re-rating back to the kind of levels that they were sort of pre-2020 when we had this regulatory overhang. So nice tailwinds, but still some level of overall caution at the ratings level.
There's another question on NASPAS process. I think people are getting a bit confused as to which one to be in. Just to remember that the Tencent and the other assets are held by Prosus. Prosus is listed in Europe, and NASPAS owns the majority of Prosus. So and NASPAS has got a small amount of South African assets, but it's by and large an investment in Prosus. So you have kind of a 35% discount to NAV at Prosus and 50% at NASPAS. So people are taking further levels of discount in each one. So which one should you own? As a default, you'd want to own the one with the biggest discount if there's discount narrowing going on. But NASPAS has significantly outpaced Prosus over the course of the last while, as it became more likely that there'd be a discount narrowing initiative, which there has been. So there has been quite big outperformance, and we've now got to the stage where they're kind of equal to each other from our assessment in terms of 12-month returns. So I'd be happy to own either. I would always naturally have a bit of a bias towards NASPAS because it's at the bigger discount. But yeah, perhaps a 60-40 in the favor of NASPAS, but not a massive driver either way. Renewable energy as an investment theme is another question. We're not welcome any of the guys to comment on it. It is a very interesting investment theme. It's something which no doubt more and more money is going to be spent in it. We have battled a bit to find viable investments in renewable energy, just from a business model point of view. So we've looked at Vestas, the big wind company, and it's just a big capex company earning fairly low returns. And as you can appreciate, most of these companies don't really have competitive edges. The renewable energy tends to be around the expenditure of capex, where the capex and services are a commodity, and they don't tend to get massive returns out of them. So we like the theme, but haven't been able to find that kind of table thumper in terms of how to best get exposure to it. James, I see you taking your...
Yeah, I would agree with that as well. And the point I always make is that great themes don't always make great investments. Sometimes they do, but not always. And this whole sort of energy debate is an incredibly, incredibly complex one. Some of these solutions work at small scale, but when you start to scale them up, you start running into problems. And for example, I've looked at Vestas myself in the past and just found it a very, very sort of confusing company. The earnings seem to jump around from quarter to quarter. They are the biggest wind turbine, manufacturers in the world. But it seems like competition is really cutthroat. Margins are thin. There's performance clawbacks every quarter from previous contracts. I think a portion of their profits is based on how much wind is blowing. I mean, that's just about impossible to forecast. And yeah, it hasn't been a great investment. It hasn't done well sort of the last couple of years. So the idea is great, but yeah, finding investable themes in asset-light, high-quality growth businesses with moats around them is extremely difficult.
Okay, guys, sorry, we had over 50 questions. We've tried to answer as many as we can. We are reaching the end of our time limits. So, yeah, I'd just like to say thank you very much. We've had an excellent attendance. Hopefully, we've given you value for time. And look forward to working with you to make money out of the opportunities going forward.